and welcome. Thank you so much for starting your day with ET Now. I'm Anisha Jain. With me is Pankaj Poddar and Pankaj. Overnight, we got positive cues coming in from the global markets. Wall Street was building on to gains. That entire worry regarding Silicon Valley Bank seems to have at least closed out for now with the acquisition news coming in. Look at that solid rally on Dow, a 200-point rally. And that just goes on to tell you that there's a massive underperformance coming in from India. There was quite a bit of risk on yesterday. Crude prices spiked suddenly 4 to 5%. In fact, crude was hovering just around that $78 to the barrel mark overnight. And there was a bit of a move when it comes to US 10-year as well, which moved to the levels of 3.53. And even the India WIX slipped a tad bit. So a bit of a mixed use coming in from the globe, but definitely a lot of underperformance coming in from India. And yesterday also we saw, Pankaj, that the rally wasn't sustaining. So the confidence is clearly lacking in the market at the moment.
Absolutely. The point is that none of the rallies seem to be really sustaining. It seems to be mostly short covering, and then you see a fizzle out coming in as far as any of the rallies are concerned, which means that people are waiting for markets to go down, then probably do some short covering, and then at higher levels they go ahead and short once again. But it's an interesting market. We have expiry tomorrow. We have the year-end closing tomorrow. So it'll be interesting to see how really things pan out in this entire week. There is a lot of news that markets need to digest. As you pointed out, this quarter most likely India would underperform other global emerging markets. So what happens to allocation to India in the first week of April will also probably be the next event to watch out for. There is a block deal today in Kalyan Jewellers, so I think that will take the number. And more importantly, Anisha, as you pointed out, there was risk on. Crude is now back to 74. Not that it's an alarming level, but definitely something which the bulls would eye out for.
Oh, well, yes, and the fact is there's a massive underperformance coming in from India, not just over the last 10 to 15 days, but even if you look at the YTD data, the Nifty is down a solid 6%, and that compares with NASDAQ, which is up 12%. So there's an underperformance to the tune of 18 percentage points coming in for India, minus 6% versus plus 12%. That's the kind of underperformance India has seen. And not only that, European markets, despite all the turmoil coming in from Credit Suisse, Deutsche Bank, etc., Euro stocks have still managed to eke out a gain of around 10%. And look at India. That's the sole ranger in the red as far as that screen is concerned. So whether it's FTSE, even the other Asian markets like of Kospi, etc., have done well. Hang Seng is just mildly in the red, but there's a massive underperformance coming in from India. And within India itself, it's the mid-cap and the small-cap index which has seen bigger cut, a bigger drubbing coming in for mid-cap index, which is down a good 9%. And yesterday, of course, we saw the kind of carnage that was there in the small-cap index. Nifty Metal, sectorally speaking, is down 20%. PSU banking space, which were the darlings of last year, have seen a correction of 17% already this year, and it seems like they are the underdogs or the defenses which are likely to do better this year. At least that's been the flavor so far of the year, given the fact that FMCG is the only index or only sectoral index which has managed to hold up in the green. But Pankaj, it's a lot of the year-end expiry thing also on the mind, right? Today is a settlement day for the T+2 stocks. People are booking losses for the tax management, etc. I think that's also playing a factor.
Absolutely, but or rather we can also say that fresh money would only come in the next financial year. So I think that is the thing to also watch out for. It's not so much about how things are moving, how things are happening, but it's just about how essentially markets are just not reacting to any news. We had the fallout, stocks fell. Now we are getting the SVB deal which has been lifted, Credit Suisse deal which the market is digesting. However, the Indian markets really not seem to be performing that much.
Oh, well, yes, but hopefully in the coming week there will be a bit of action, because if you look at the next 7 days, quite a few news items are lined up. Of course, tomorrow is the monthly options expiry. Remember, it's a truncated week, so we're watching out for that. The financial year end and the adjustments on account of that are expected as well. There's a bit of a flow adjustment expected as well. It always happens towards the year end, as well as the management of the NAV of some of the mutual funds, etc. also happens. It will be the auto sales data that will come over the weekend, and next week is the big event with respect to the RBI MPC decision. We'll get to know it only on April 6th, but the meeting will start on April 3rd itself. So lots of things to lined up.
Well, Anisha, it was quite interesting last week. We had a lot of central bankers meeting, and some of them did raise rates quite significantly, but Indonesia was the one which we track with our markets, and Turkey. Both of these markets did not. Both of these bankers did not raise rates. So the next thing is that what happens in India. These were the only two banks that did not raise rates in the previous week that went by. So I think it'll be interesting to see how markets are positioned.
Oh, well, yes, but the fact is that we have been fairly range bound. It's been a boring kind of market between 16,800, 17,200, and massive resistance coming in at the 17,200 level. And that's been the, broad range that the markets are working with. But could we say that the worst is behind when it comes to the benchmark indices? Well, probably not, because Lawrence Polanco believes that there's going to be a lot of volatility, and the broad range for the Nifty is likely to be 15,400 on the downside, and the upside might be limited to 20,700. Listen in.
Well, our base case is that we're expecting to see further volatility in the trading range that the Nifty's set up, basically from the peak that you made in late 2021. And that range, unfortunately, is fairly wide. We're talking about a 15 to 70% wide trading range, which has provided support around that 15,400 area for the Nifty, and resistance up at the 18,600. The positive short-term setup is that we did find support at the 16,700 area on late last week, and we continue to hold that in early trade on. So best case scenario is that we're holding the upper boundary of that trading range. But the fact that the Nifty remains trendless would suggest that at least for the next 2 quarters, we're likely to see further relative underperformance if you look at it versus an EM basket at least. Also, we can continue to hold the 16,800 to 18,600. That would be the best case scenario. The weakest scenario would be a break below the 16,800, and that would open the door for a move to the bottom of the range, which comes through at the 15,400 area. The trends are still very positive for the broader market, and we still got upside targets of 20,700 to 20,800. But we have mentioned before, that it's not uncommon for the Nifty to spend a number of months, if not years, trading in a range. I mean, you can go back to the 2010 to 14 scenario that you consolidated the gains of the 2009 lows before you broke out in 2014. And then you saw a similar 12-month period between 2015 and 16 where the market digested the gains following the breakout from 2014. And currently we're pushing on to 16 months of a ranging period, and that could extend for another 6 months at the very least, but it doesn't alter the longer term structure, which remains bullish.
Let's welcome in our first guest on the show. Nuresh and Kunal both are with us. Nuresh, let's start with you. What's the perspective as far as Nifty goes? You think a couple of days of this financial adjustment and then we'll get a clearer picture, or what levels would you wait and watch out for?
So it's been that same tight range of 16,800 to 17,200. Even though there has been a little bit of a recovery globally, we've not seen that take it beyond that 17,200 mark. So once we start closing above the 17,200 mark, that is where we say there is a short-term reversal and we go towards 17,600. Overall, the bias is still positive till the time we hold 16,800. We've seen a little bit of a recovery globally as well over the last few sessions. Again, a similar price point for a Dow Jones index would be 32,800. So we are waiting for some more price action to confirm momentum, but as of now, still stuck in the range.
And Nifty, what will be your call, Nuresh?
So it is still a hold on the Nifty. Would be adding more positions once we cross 17,200.
Okay. Kunal, the same question to you. How would you look at Nifty? Yesterday we tried to move up, but once again could not sustain.
Good morning, Pankaj. Again, I think it's more of a range-bound action because the indices are stuck into this 400-point range on the Nifty, 16,800 to 17,200. It becomes very difficult to try and look out for any kind of a view. So even if you look at the net damage for the indices in the last 4 or 5 trading sessions, we've not seen any major damage. I think in the last week, we had a session where the markets used to close at the slight higher points of the day at 17,100, 150 odd levels. And the last couple of days, we've seen the indices get into a correction the last half an hour, 45 odd minutes. So netted, it tends to balance out at the 17,000 odd mark, plus or minus 200 points. I think a major trend which has to emerge now is that there are many sectors which are actually come back into an oversold territory. So, for example, the auto stocks, pharma names have come back into an oversold territory. Auto stocks, IT names are the ones which are coming back into an oversold territory. So I believe that there are higher chances of the markets, especially the individual sectors, getting into a recovery mode from here on. Also, today is the monthly expiry, so it's going to be very, very important because right now the premium for the for the April futures is still at 130, 140 points, which is still at par or slight higher than the previous month premium for the indices, where it was almost at 110 to 120 odd points. So which means that we need to see that if the rollovers are also very strong and quite buoyant, then we can expect that the markets will probably go into the April series with not as much of uncertainty as what we've seen the last couple of months.
Fair enough, Kunal. But this year so far, we have seen the Nifty has been a massive underperformer compared to the global markets, and it's perhaps first time in 20 years that Nifty would be closing in the red for fourth consecutive month. What do you think is the importance and significance of that?
Yeah, it's correction. The expiry is tomorrow. So I think it's a very significant kind of a data point because we I think we discussed on this data point some time back that the indices have had 3 successive months of negative price correction, and the fourth month tends to be, at least over the last 2 decades, where the markets have seen a decent bounce for the indices after 3 straight months of correction. But whenever we've seen fourth and fifth straight month of correction, those have actually resulted into the indices going into a very sharp correction. That was in 1998, 1999, as well as 2001, where the indices had seen such a kind of a sharp correction for itself in the fourth and the fifth consecutive month. So, we can just hope and expect that possibly in the next couple of days before we end this calendar year, there could be some bit of recovery and the Nifty may at least close into a flattish to slight green positive territory. But then the history is not in very strong favor when we've looked at the data points, the 3 exceptional data points when the indices have closed and fallen by more than 3 months.
Fair enough. Let's get the stock specific recommendations out of the way as well this morning. Nuresh, what are the stocks that are on your radar?
Still continue to be on the large caps. First is a buy on Axis Bank. The stock has corrected well and has now made a base around 800, 815 levels. Should see a breakout above 855, 860. A risk reward trade here with a stop loss at 805 and a target price of 900. Second is a buy on Godrej Consumer, one of the few names which is actually giving a breakout in the current markets, as well as the stock is sustained above the breakout points. It would be a cup and handle breakout above this 960 mark. A stop loss at 945 and a short-term target price of 1020.
Okay, so Axis Bank, Godrej Consumer sticking to the large caps given the fact that the mid caps and the small caps have been underperforming. Kunal, what about you? Are you also sticking to some of the large cap names?
So yeah, sticking to large cap names and slight defensive tilt over here, Nisha. So 2 buy calls. The first one is about Cipla. I think I've been bullish on the stock over the last 1 or 2 weeks, even though the stock has been a bit more sideways after a sharp correction. My sense is the stock is forming a base formation over here and ready to go back about that 920 to 940 odd mark. So traders could look at a buy. 920 could be an immediate target. 870 as a stop loss from current levels. The second stock would be about Shree Cement. Apparently, this is the only sector which has actually remained a lot more sturdier as compared to the other sectors. Shree Cement is on the verge of a triangular pattern as well as a bullish flag pattern breakout. So it's best to buy 26,500 as a target. Stop loss at 25,000.
Right, just hang on with us, Kunal and Nuresh. Let's hear out none other than Mark Mobius. We spoke to him earlier and he said after the correction, he would be one of the first ones to increase the allocation in the tech space in India. Says any correction in the sector is a buying opportunity.
No, the reason why I'm not worried is that when you get down to it, when companies are in trouble or when societies are in trouble, when governments are in trouble, they turn to technology to solve their problems. And technology often can solve their problems. So the technology area is going to grow globally in any case. But more importantly, India is going to be taking a bigger and bigger role in the semiconductor and hardware area, the semiconductor technology area. And the reason for that is that the problems with China and the US means that a lot of the manufacturing that has been taking place in China has to move away. That's the reason why Taiwan manufacturers are looking to India as a place to manufacture and to keep up their services to their clients in America and Europe.
Okay, let's welcome on board the management at Crompton Consumer as well. Mr. Shantanu Khosla, the Managing Director at Crompton Greaves Consumer Electricals joins us. He's joining in to talk to us about the merger announcement coming in with Butterfly Gandhimathi and what does it really mean for the company. Mr. Khosla, I wanted to begin with understanding the timeline of the merger because at the time of acquisition last year, the understanding was that the merger will be done in 3 to 5 years. Is there a reason why you have moved up the merger timeline?
No, we haven't really moved up the timeline in that sense. When last year when we first acquired majority shareholding of Butterfly, as I mentioned that time, our first objective was to make sure that we continue to run the business and understand the business and make sure the business and organization is stable and running well. Once we have done that, and now we believe that we have confidence in that, especially given our performance versus a lot of our competition in the space, we believe the time is right to move forward with a merger recommendation. The reality is actually it is only the beginning of the process. It will take another 12 to 14 months before we complete the process and actually can begin to get all the benefits. But it has become clear to us that operating as a single legal entity will help us, enable us to accelerate some of our revenue and cost synergy opportunities.
We haven't seen the benefit of synergy so far, revenue and cost synergy. How will they play out over the next couple of years?
Absolutely. As you rightly mentioned, in this initial period, we have largely been focusing on cost synergies. We have not yet been really focusing that much on the revenue synergies. We have begun the cost synergies, and we have got cost synergies in this period in areas such as combining purchase, making sure that we're buying commodities at larger scale, making sure we're buying media at larger scale. As we move forward, there are clearly further opportunities in both cost, but more importantly, revenue synergies, which we want to accelerate and enable. In terms of when we start looking at the cost synergies, beyond what we've already done, there are clearly other areas. For example, if we look at the supply chain, there is a reasonable duplication, especially in areas where Butterfly is not that strong, of warehouses in the logistics chain. Do we really need 2 warehouses in a particular city in the north when one would suffice, etc.? And there are various other opportunities. A combined IT and ERP system would be more efficient, etc. So we will keep working those cost synergies, but you will see more areas of cost synergy coming to play as we move forward. And when we actually do merge, these will get even more accelerated. Moving on to revenue synergies, and frankly, in my opinion, from a strategic point of view, the revenue synergies are even more important to start coming. One of the biggest areas of revenue synergy is in our ability to grow Butterfly in areas where Butterfly today is weak. As you know, Butterfly is largely a South-based business, but if we need to meet our objectives, we need to grow Butterfly in the West and the North particularly. This means strengthening and expanding our go-to-market in these 2 regions.
No, sure, Mr. Khosa, that point is taken, but help us quantify some of these. By when will we see the revenue synergies actually flow in with respect to the timeline? And if you can quantify any number for us with respect to what could be the synergy?
Again, I don't want to, because we don't normally give forward-looking numbers, but so I could put it, I can put it this way. One, we would expect these revenue synergies to lead to a business growth which is a couple of points across each category ahead of market growth. Second, we would expect these synergies over the midterm to take us towards a leadership share position. Today on the Butterfly brand, we are roughly a 10 share on an average in the South and low single digits in the rest of the country. Through the midterm of the next few years, we would hope these to get us to about a 10 share nationally.
Right. So could you just tell us about the EPS accretion, whether it happens in the following financial year or FY25? Is there a gap because of the slowdown?
Not really. So we do expect the merger to be EPS accretive from the first year of it being effective.
So does that mean FY25? Is that what I should infer when you say 1 year of merger completion?
If you assume that beginning of FY24 it actually gets approved and rolls out, then 25 it would be accretive.
Let's talk about margins then. Operating margins for Butterfly is at about 9-10, while for Crompton Consumer is at about 15%. What is the outlook in terms of margins going ahead?
Let me talk about the butterfly bit and how we're thinking about it, because that's the new part. See, Butterfly historically had a 6 to 8% margin, and through this year we've taken it up close to about a 10%, 9 to 10%. Now, our focus is less on taking this 10 to 15 and more on reinvesting savings to grow the share and the top line of Butterfly. So we don't expect the margins to fall. And we do expect that over time, there will be a gradual, slow movement up of margins. But the priority will be to grow the top line and the market share.
Okay, Mr. Khosla, we'll let you go on that note. I appreciate you joining us on ET Now today. So that's the word coming in, looking at revenue synergies, talking about a market share of 10% on a national level, and saying that it'll be EPS accretive from first year of the merger as well. But shifting focus to what's happening in the telecom world, and believe me, a lot is happening. In fact, in Jio's latest salvo to beat the competition, the company has launched new broadband plans, with the cheapest one being just for 198 rupees per month. This will increase its addressable market size significantly and will heat up the competition a lot more. So Amit is joining us with the details on that, and what does this mean for the sector, which is already facing the competition burns as well. So Amit, take it away.
Well, this is Reliance Jio's second attempt to get more users on the broadband plan, and this time they have come out with the cheapest broadband plan on the street at just 198. In fact, the plan is cheaper than many postpaid plans that are available currently in the market. Now, they are offering around 7 new plans and have revamped 2 of their existing plans, and the plans start from the range of around 198 rupees to 1499 rupees. Now, the higher range plans are also bundled with OTT apps and live TV channels. Like, for example, the 299 plan has been bundled with 40 Mbps of speed, 6 OTT apps and nearly 400 live TV channels, and the 398 is bundled with a higher speed but around 14 OTT apps and 550 live TV channels. So why has Reliance Jio come out with these new plans currently? Because as a fact, everyone knows that IPL will be starting soon, and any viewer can watch IPL for free on Jio Cinema. And to make the most of it, Reliance Jio has come out with these new broadband plans right before IPL is expected to start. Now, these plans will also target customers on the lower side of the affordability and speed criteria, and mainly these new plans will be targeting the cable and the DTH users. Because of these new plans, the total addressable market size of Reliance Jio increases. And by how much does it increase? By nearly 11 crore, because there are more than 4.5 crore cable users in India and nearly 6.5 crore DTH users in India, and these users spend on an average nearly 150 to 200 rupees per month on this cable and DTH recharge, which could now move to Reliance Jio. So this will give us an idea of what could be the potential market size or the market size increase for Reliance Jio because of these new plans. Now, just to give an idea of how the broadband user base has increased before and after Reliance Jio's launch. So Reliance Jio has first come out with its plans in August 2020, and 3-year CAGR, if you see the growth rate till August 20, it was just 4.2%. But since Reliance Jio had come out with its first set of plans, the subscriber base of broadband has increased at a CAGR of nearly 22%, and this kind of similar growth can be seen even going forward. However, there are some concerns with this new plan. Firstly, the fact that company had earlier spent more than 10,000 crore rupees to acquire Hathway and then which are cable operators in India, and given the fact these new plans are targeting cable users, this investment investment now becomes redundant for Reliance Industries. Along with this, this new plan could also cannibalize the growth in 5G user base going forward, because more users, if stick to broadband plans, then the growth of 5G could be further delayed according to analysts.
All right. Thanks for that. So Bharti could be a stock to watch out for in the listed space. Aditya Birla Capital is also in focus, and Ashesha is now with us. She's telling us what's the latest as far as their insurance broking business is concerned. Ashesha, tell us more.
Well, yes, absolutely. Aditya Birla Capital will be in focus today, and that is because Board of Directors of Aditya Birla Capital have approved stake sale of the entire stake that they held in the insurance broking arm of the company, Aditya Birla Insurance Brokers Limited. Aditya Birla Capital held a little over 50% stake in this particular insurance company, and the other party which held 49.9% stake, both of these parties will be selling their stake in the company. Each seller will receive an additional consideration after a period of 5 years, subject to fulfillment of certain conditions. Now this entire subsidiary is being sold at a valuation of about 455 crore rupees, implying a valuation of 5 times considering September 2022 profit levels. Now Morgan Stanley has come out with a note where they say that they value this insurance arm of the company at about 1140 crore rupees, which implied a valuation of 12 times September 2022 profit levels, which means that this stake sale is being done at a steep 60% discount when we compare the valuations that were done by Morgan Stanley. Post-holding company discount of 20%, remember this particular arm constitutes about 1.4% of the SOTP valuation of the full company. So on account of this stake sale that is being done by Aditya Birla Capital, especially because it is being done at a steep discount to valuation that was given by brokerages, keep an eye out on this stock in today's trading session.
Thanks, Ashesha, for joining us with that quick take as to what's happening with the corporate developments at Aditya Birla as well. Thank you so much. But moving on and talking about what's happening in the world of crude, because there was a massive spike overnight as well. It reached a level of $78 to the barrel. Remember, this all happened after Iraq was forced to halt some of the exports. The exports were halted from the semi-autonomous Kurdistan region as well. And Turkey too has stopped pumping crude from Kurdistan via pipeline. To add to that, the US banking acquisition has eased the worries that there's going to be an economic turmoil and that will lead to a reduction in oil demand. So all of those worries are away. So one is the supply crunch coming in with that export coming to a halt, and the second is from the demand side as well. There is that expectation that there might not be such a big negative impact or a drawdown from the US banking contagion effect. Remember, the exports form almost 0.5% of the global oil supply. So quite important that is. Kunal, wanted your take because you track the charts of crude quite closely as well as sudden spike coming in, but where do you see it headed from here on, Kunal?
So broadly, Anisha, my sense is that the crude oil prices should probably remain into a range. So what we highlighted earlier as well, that $75 plus or minus $8 to $10 has been the broad range for crude oil prices, Brent crude specifically. And I believe that we are just still at the midpoint of this $20 odd point range for the dollar index for the crude. So my sense is that we may probably come back to the upper end of the range, which is around 82.5 or 83 levels to be precise on the Brent crude. And if that happens, maybe that could be an opportunity to try and trade fresh shorts. We have to look out for the structure. So the structure for crude oil over the last, I think, 1.5 odd year has been a formation of lower tops and lower bottoms. So the structure is negative unless there is something dramatically which changes the perspective of crude oil prices completely. Then we expect that probably this trend would reverse. But as of now, looking at the last 1 year of trend for crude oil prices, I would expect that this trend would continue on the downside. And maybe if the crude oil prices bounces back towards 80 to 83 levels, that could be an opportunity to probably try and trade fresh shorts.
80 to 83, that's what Kunal is eyeing out for. Digant Arya is now with us. Digant, thanks so much for taking out time for us. Let's start with NBFCs, Digant. I mean, that's something which you've been tracking, really for a long time. You think that, if there is any sense that rates in the system are peaking out, you think NBFCs will be the first one to benefit because they've not done as well as banks? Then you had the entire IL&FS issue where, NBFCs were forced to change their liability and asset models. How do you see the sector placed now?
Hi, thanks for having me here. I think the rates peaking out because of whatever happens globally. See the rates, there are two ways in which the rates can peak out. One is that, we break the back of inflation and then the rates peak out. So that is a, very good setup for a big macro rally in the economy as well as in NBFCs. But here, we are seeing a little bit of, peaking out of rate because I think there is a sort of demand destruction kind of a scenario globally. What happened in the US with the banking system, and now it's spread to the Europe. So I think this rate reduction is largely to do with a demand destruction or a softer demand kind of a scenario. So I think no, it's a little early to celebrate and say that NBFCs will just start doing well because see the rates fine. The rates are going to probably peak out or maybe they'll start declining say 6 months down the line. But the point is what happens to the demand. What happens to the end consumer segments. So in NBFCs the largest segment is the housing finance companies. Housing finance companies, at 9%, 9.5% kind of home loan rates, you're not going to see a massive growth. The premium end of the housing will still do well, but those customers take loans from banks and, not really from the housing finance companies. Second, you come to CV finance companies. I think that is one bright spot because the underlying demand is very strong. The resale rates of the vehicles are quite high because of the inflation and the cash flows are good. So I think this is one segment where, I would really stick out my neck and say that, in the next 12 months, you can look at good positive returns in this sector. And third is microfinance. Microfinance is again where, it's in its own world and, the demand is really started picking up. So that's one sector where you will see 25% kind of growth. But apart from these two, commercial vehicles and microfinance, I think it's a struggle. Consumer finance will struggle, gold finance will struggle, housing finance will struggle. So I think you have to pick and choose. It's bottoms up, even in the NBFC sector, not just like the whole sector rallying together.
Need to be stock specific when it comes to NBFCs as well. But Digant, I wonder if you have looked at the latest announcement coming in from Paytm regarding the interoperability, because they have announced that Paytm wallet is now universally acceptable on all UPI QRs and online merchants, as NPCI has announced that KYC wallet interoperability is now completed. Do you think that could materially change the fate of Paytm and overall your outlook as far as that stock is concerned?
See, I think incrementally it's, see the Paytm's payment business was always a loss-making business or at best a break-even business because that was the business which they used to recruit users like you and me and all the merchants, the Kirana shops and the vegetable vendors and a lot of other merchants who do small-time businesses. So this business was always, thought of as, you get people on your platform and then you try to cross-sell something to them. And cross-sell, I think Paytm, the only thing they've successfully cross-sold is the loans. They've been successful at cross-selling loans, the buy now, pay later kind of consumption loans and the merchant loans. So I think this interoperability, what it does is, it just increases the probability of customers sticking more to your platform. And once the customers stick more to your platform, you can cross-sell them a little more. So I think in that sense, it is incrementally positive for Paytm. But I think that, the model still has a lot to evolve. All these new age companies, they really, may or may not be fully compliant with what the RBI guidelines around lending and, partnership with other NBFCs and banks are. So I think incrementally, yes, positive, but not something that we will just go gaga over as yet.
Okay, wait and watch and see what impact does it have. But yes, incremental positive coming in for Paytm. But let's shift focus and talk about the power sector. Praveer Sinha of Tata Power says that the company is in discussions with the shareholders and the government regarding the Mundra PPA, because remember that supplementary PPA is long overdue. The company was talking about completing it by March this year, but it seems to have been pushed a bit down the road as well. Listen into his conversation with my colleague Aishwarya Patil.
We are in discussions with all the stakeholders, including Government of India, and we do expect that this will happen sooner than later. So let's hope that we can conclude a mutually acceptable arrangement acceptable to all the procurers as well as to us and the government, so that the plant can operate at full capacity and provide competitive rate power to the consumers.
So in terms of profitability and under recoveries, can you comment a little bit on that, since this Mundra and PPA will soon be fruitful after post the announcement comes in? A word on that.
At this stage, we are in silent period and we would not be able to give any details. So once our results are declared in the month of May, we will be able to share more details.
So a word on the renewables business. How do you expect it to grow? What is the capacity expansion that you have? What's the outlook like for this year?
So our renewable business is doing very good. As you know that we are in the all the areas of renewable business, including manufacturing, EPC, utility scale, rooftop, solar pumps. And I think in each of these segments, we've done very well in last 3 years. And I think the foundation is very strong for this business to really grow at a much faster pace in the coming years.
Okay, so power sector definitely in focus. Remember, this year we have seen a solid surge in the demand, almost double-digit to the tune of 10 to 11% this year so far. And the street is expecting it's going to be quite robust in the coming year as well, given the fact it's going to be a scorching summer. And that's something which is likely to do well, at least for the power companies. But it can also augur good news for a lot of these consumer durable players. And that's the reason Sandeep Sabharwal is betting on some of these consumer durable names. Let's listen into his top bets.
There was a flurry of activity in summer-related stocks, and that's why investing on the basis of weather predictions always is very difficult. So some people bought in the expectation of a heat wave. Some people are selling some stocks in the expectation of El Nino, but no one knows what's actually going to happen. But I think some of these stocks like Voltas, Havels, Crompton Consumer, etc. I think they are in reasonable zone from a risk-reward perspective. In terms of downside risk to upside potential should be 1:3. So there could be potentially a 10% downside if things go wrong and markets sell off. But as things stabilize and demand comes back, we could potentially see a 25-30% upside in many of them.
Since we were discussing the power sector and discussing it with Praveer of Tata Power, I want a take, Nuresh, from you as far as the stock of Tata Power is concerned. It was seeing quite a bit of price volume action on the negative side yesterday. It ended with a cut of around 3 to 4%. Where do you see that one is headed, and do you have a top bet when it comes to the power sector?
So in Tata Power actually was bullish till the time it was holding above the 200 mark. Made quite a few attempts above that 200 mark to make a bounce back, went up to 215 multiple times. Now it's finally broken below that 200 mark, which was the low for the last almost 18 months. And there were 6 to 7 attempts. So that clearly tells you that the final momentum is on the downside now, not being able to hold it. And the whole rally started from, say, closer to 145, 150 levels. And the next support is at 175. So technically the last 3 days it's given a breakdown. And 175 would be a potential target on the downside. But till the time it does not break back above the 205 mark, the stock remains in a downward pressure. In terms of power, I'll continue to stick the PSU names, which is NTPC and Power Grid, as the good places to hide.
Right, so that's on the power side of the market. Let's go across to Winnie now. UPL is a stock that is in focus, continues to be the case. This is due to what's happening as far as the announcements regarding acquisition of shares is concerned from the top management. Winnie has been scanning through that entire data and what's really happening over there. Winnie, tell us more.
Absolutely, and UPL promoter groups have acquired 23 lakh shares on a YTD basis. They've acquired 60 lakh shares. This is perceived as normally, that the company, the promoters have more conviction in the company as well. So now UPL promoters are holding 31.5% stake, which is the highest since December 2005. Let's just talk about some of the triggers that come in for UPL, what the analysts are talking about as well. And obviously, in terms of valuation, 10 to 30% discount to other global generic leaders is what UPL is currently at. Now, other than that, what analysts also expect that UPL is to maintain a good, robust growth trend going forward as well in terms of various regions, propelled by a good volume growth. Other than that, they're also anticipating a CAGR of around 8% in the company's top line. And not only that, they anticipate that Europe, North America as well as Latin will continue to deliver a robust growth as well, higher value products as well, which will be supporting the company's market share gains. So yes, in terms of valuations, seem at a discount. They will be gaining market share in Europe as well as US. Improving margin trajectory is another point that one should be keeping an eye out on, because UPL's robust top line growth will obviously be leading to mainly led by the driven by the mix in terms of which will be improving through the DNS growth and will augur well for the revenue growth as well. And improvement in margin trajectory over the mid to long term is what analysts are expecting. So yes, so overall those are the positives that we're watching out for. Risks will be El Nino fears that will be there. Overall, 25 out of 27 analysts have still maintained a buy rating on the company, and analysts' consensus target price is 1,018 rupees per share.
Digant, do you track UPL closely or any of the chemical companies? Because there was China +1 earlier, now there's Europe +1, and it seems like a lot of these export orders are coming India's way, especially in specialty chemicals.
We're tracking it only in terms of the top down as to when the pricing erosion stops, and like we had a euphoria in the chemical sector in the last 3-4 years. The margins expanded, a lot of players announced capex, and now suddenly there's a slowdown in demand across the world. So I think this sector is best left to its own. Let it fight its own battle, and I think it's another maybe 6 months, so to say, before the stocks and the businesses bottom out. So I think we are watching this space, but not like we're just very gaga over the space right now, because I think it's rallied, like most of the stocks rallied 5 to 10x between 2018 to 21. And I think after such a rally, and when there's capex and demand is slow, we see years of sideways consolidation. So I think the down journey is probably over in many stocks, but the sideways consolidation will still be there. So we have not done a lot of bottoms up work on the sector. Let the top down settle first, and then we'll get into action in this sector.
Right. Let's now go across to an important story on TCS. My colleague is now with us on the phone line, Surbhi Agarwal from the Economic Times. Surbhi, what are you picking up in terms of the latest as far as TCS top leadership is concerned?
Right. So good morning. Thank you for having me, first of all, on the show. So as we've been reporting 2 weeks ago, TCS had a big move when its CEO Rajesh Gopinathan resigned suddenly. In fact, the development kind of sent shockwaves in the industry, because he had 4 years still remaining in his tenure as CEO, and he was running a very steady ship at TCS. But what we are picking up is that it's not just a CEO movement happening at TCS, but several other movements are happening at the C-suite level. Some of the significant ones include changes at the CTO level, changes at the COO level. They also need a BFSI head because the person who's been picked to replace Rajesh Gopinathan was a BFSI head. So to give you more details, basically the CTO, who's currently Mr. Anand Krishnan, he's retiring at the end of October, and the company has internally picked Harik Wynn, who's currently the innovation officer, to succeed him in the CTO role. This will happen in October. The CEO, who's currently N. Ganpati Subramaniam, is also retiring at the end of May 2024 after a 40-year stint at TCS. So the company is internally also kind of scouting for candidates who can fill in for that position. As per our sources, the current president, Mr. Ramanujam Krishnan, is one of the frontrunners for the post. There are other contenders as well who are all presidents. Those include names like Debashish Ghosh, Mr. Sushil. So these are the people who are being considered. And as is the practice with TCS, they always dip into their internal pool when it comes to hiring for the CXO level. We are also being told that the companies already start succession planning several months in advance when any of its CXO level people either retire or they quit. So that is what it is. There's another movement. The chief diversity officer of the company, who Miss Ritu Anand, is also retiring in March, and the company has picked Miss Preeti DeMello, who's right now based in the United States, to succeed her. So those are some 3-4 changes happening at the top level. Now, a company of TCS's stature, the largest Indian IT company with over $25 billion in revenue. So many changes happening at the C-suite level is significant as per our reading.
No, absolutely, Surbhi, and this is coming at a time when the global IT sector is going through a bit of a demand slowdown as well. So very critical to watch, because the way things are unraveling and the demand is expected to taper a bit, especially from the BFSI sector. It'll be critical how the top management wades through this volatility as well. But Kunal, wanted your take regarding the entire IT sector, because this morning there was a note coming in from Citi as well, wherein they've opened a negative catalyst watch on Tech Mahindra for 90 days. They have a target of 1120, have an overall neutral call, but they say that the industry view is cautious in a tough macro environment, and the company does have room to improve the margin in the medium term, but for the next 90 days, they've opened a negative catalyst watch. How are you viewing some of these tech majors, Kunal, TCS, Infosys, Tech Mahindra, Wipro, etc.?
So I'll look at it in this way, Nisha, that most of these IT stocks have actually gone through a phase of rally for themselves in 2023's first couple of months, and then now these stocks have gone back into a corrective phase. So even if I start with the Nifty IT index, we're back to that December 2022 lows for the IT index, where I think we made a low of 28,500 approximately on the IT index. And after a rally towards 31,500, we are back to those levels for the Nifty IT. Now we look at the components of the Nifty IT index, which have been the major components which have actually corrected in this leg of price trend for the IT index from 31,500 to 28,500 currently. And it's the likes of Infosys and TCS specifically which have corrected. Wipro has been one stock which has been actually correcting quite consistently over the last many months. In fact, over the last 1 year, when the IT correction started off, Wipro has shed more than, I think, 40% from the peaks for itself. So that itself tells you that the move for the IT index was getting a bit more bifurcated, but it's just that in the last few weeks, most of the large cap stocks have started to participate on the downside. Tech Mahindra apparently has been one of the stocks which have actually been more resilient, and that stock has been staying above that 1100 odd mark broadly. The stock was forming a bullish flag pattern, so we need to see that how the stock reacts post this news flow. But there is no major gas to the stock price, and if it holds on to that 1100 mark broadly, then I would still believe that Tech Mahindra, the chart structure is quite positive. Other than that, I think these stocks are still way above their August or September 2022 lows. So there is still a buffer and cushion for the IT index as well as large cap names by a matter of 5 to 7%. So till the time there is no major correction or these stocks fall back below their August or September 2022 lows, my view would be to try and look out for more buying on dips into these stocks rather than looking out for selling opportunities.
All right, let's focus on banks for a bit as well. Let's go across to Sanjeev Bhasin. One of his top fundamental ideas is that he's betting in big on the banking names. Sanjeev, tell us more.
Everyone was chasing State Bank at 600. At 510, I think this is a steal. Same is the case with another PSU bank like PNB or Can Bank. All will report record profits. Yield softening is a plus for them. And plus, look at the macro environment. They are all seeing, if I could hear Mr. Dinesh Kare, he said no impact of growth. In fact, the rural markets have started to see very, very strong growth. And I think banks are a proxy to that. Look at a stock like LTIM, the Mindtree L&T investment. I think their guidance is extremely positive. So, and if IT is going to play a catch-up, then LTIM or an HCL Tech can be outperformers. Look at stocks like JSW Steel, which I think can be a very, very big outperformer given that coke prices have softened and a weak dollar means China demand will give them a real impetus. Look at stocks like Escorts, where again Kubota is now signaling that they are going to get more market share from Mahindra. And I think that this whole dialogue on drought and all is overdone. I think Escorts will rule the roost. If you are a long-term investor at 13 times, you're getting an MNC. And last but not least, Godrej Consumer Product. I think that is shining its way through the glory. So these 5-7 stocks are looking outperformers.
Okay, so those were some of the top banking names that Sanjeev Bhasin is quite positive on. But what about the metal sector? Digant, what's your take? Because yesterday there was a note coming in from BofA. They were quite positive when it comes to metals as a whole. As well as today, Vedanta will be in focus on account of the 5th interim dividend announcement as well. Any top bets here?
See, in the metal sector, in the past, China had always been like a big driver for, the metal demand across the world. I think China has opened up, so we will see some, some good demand coming from that for, say, the next 9 to 10 months. But let me tell you that, uh, Chinese economy was actually slowing down even before these lockdowns. So while maybe 6 9 months look great for the metal sector in general, beyond that we will face the same problem of a high base, like what we are seeing in a lot of other consumer companies in India. That once you made a high base of the post-COVID opening, it's very difficult to grow at, say, even 7 8% for these companies. So I think metals. But what is different this time is that, see, most of the balance sheets are completely light. They're not as levered as in the past. So I think in metals there are pockets of opportunities which are definitely there. I think Tata Steel is our topic because they have delevered the balance sheets quite well, and their chorus operations is the only one that that is a thorn in the overall investment argument. But I think the domestic part of metals is absolutely quite strong. And Anisha, in this metal space, we are more bullish on the ancillary metal plays. So ancillary metal plays like, say, an RHI, which gives a refractory material which is used in the blast furnace, or something like a Foseco, which gives you chemicals to make good metal castings. These castings are used in, say, an automobile sector and so on. So in the metal space, we are not directly wanting to play the actual metal stocks, because globally our view is that globally we are entering a period of moderate to slower growth only, and which is why the pure metal companies will find it difficult to beat the profits that we saw in 2021. And hence, we are playing more on the ancillary part of the metal sector, which is the castings and consumables which are used in the metal making process.
Right. So metals look interesting from a 3-6 months perspective, but once again, as just things are opening up, he's saying that one needs to wait and watch on the developments as well. Let's go across to Vamakshi now. She's standing by. Wellspun India Management met B&K Securities. She's been scanning through the report to find out the takeaways, what has been the latest on demand, what has been the latest in terms of margins. Vamakshi, tell us more.
Well, absolutely. Let's first look at the demand scenario. We have that the demand in the home textile segment has remained stagnant over the last few quarters. In fact, the lower discretionary spend is one of the reasons why the demand has remained stagnant, and that has come in on account of inflation as well as the glut in the inventory of major retailers. The situation, however, now seems to be improving, and inventory is now reducing, and the companies have now started placing orders. In fact, in the fourth quarter, volume performance is expected to be marginally better as compared to the third quarter. Apart from that, when we look at the average cotton prices, they're 7% lower. The average freight costs have also come down significantly, and that could in turn support the margins going ahead. The flooring business profitability is expected to remain flat. The hard tile exports are expected to be impacted because there is a housing slump that is going on in the USA. But on the other hand, the domestic demand for the flooring business is looking quite resilient. Now, apart from that, when we look at their capex, largely all of their capex is done. The capex cycle is behind us for Wellspun India, but now they will be focusing on debt reduction. In fact, the management highlighted that they are expecting net debt to go down by another 200 crores this quarter. Apart from that, the recent announcement that they made with Disney is that the licensing agreement with Disney is now progressing. They also have started sourcing orders. So largely those were the important key takeaways that have come in from the management of Wellspun India.
IEX is also in focus. Sharad is now with us. There are, due to various reasons, that IEX is in focus. Sharad, tell us, all about IEX.
Well, yes, multiple headwinds coming in from IEX, and do remember that the March volumes, that itself has also gone down. It's almost down 12% on a year-on-year basis. Now, of course, the impact is, of course, due to the unseasonal rains which has come, and also there has been a dip coming in the temperature over the last few days. Now, what this happens is the demand for the electricity, that also kind of falls down, and the peak electricity demand numbers have actually fallen down in India, and this has actually impacted the volumes of the exchange. Now, the analysts are estimating there would be potential down risk coming in, at least for the EPS estimates as well. Now, let's looking at the numbers also. The average prices in Indian Energy Exchange has actually fallen 16% on a month-on-month basis. And if you look at the All India electricity supply, that itself is down almost 1.6% on a year-on-year basis. And if we talk about the last 7 days itself, the numbers have been bigger, ranging between 4 to 7%, whether you compare it sequentially or whether you compare it on a year-on-year basis. And however, last trading session also the stock was under pressure, as we had learned from the con call of Dalmia Bharat that they would be actually eventually reducing their stake and finally exiting to the total stake in the India Energy Exchange. Now, currently they are having almost 14.81% stake in India Energy Exchange.
Okay, Shara, thank you so much for joining us. So IEX was down a solid 6% yesterday. Let's see how it trends today, because the fundamental news flow is also not looking very pretty for IEX with respect to the volumes as well. But let's talk about some of the other stocks which are going to be in focus, and one of them is going to be Kalyan Jewellers. There's a big block deal which is expected. There's a 2.6 crore share or 2.5% of equity which will come into the markets today, because it's expected Warburg Pincus is going to offload some shares, and the floor price has been decided at 110, which means at a discount of almost 7.5 rupees to the current market price. So there might be a bit of a downtick there, and Warburg Pincus currently holds 26% stake, and that tells you that there might be incremental supply pressure coming in for that one as well. Digant, not sure if you track this one closely, but if you look at even Titan and the other consumer discretionary names, etc., they haven't been doing very well. There have been a lot of sideways move at best. Your take?
Yeah, see, we saw very big pent-up demand in 2022. When after we reopened for COVID, the marriage season was in full swing, and because people were not calling a lot of guests, someone who would call 1,000 guests were just calling 200 guests, and the incremental money saved was actually being spent in the jewelry. So in fact, Titan and Kalyan and everybody told us on their con calls and analyst interactions that the ticket size has actually gone up. So now you really have made a very high base for yourself in the last 12 or 15 months. It's very difficult that you will beat this base so easily, because now we are in a normal world where things revert back to the pre-COVID days, and then this excess spending which was there on gold, I think the next 12 months we'll see some bit of demand which will normalize. I would not say a demand slowdown, but demand which will normalize. And the second thing is that, see, we as Indians, whenever the gold prices really shoot up, we just postpone our purchases of gold, because now the gold prices are touching, say, 59,000-60,000 rupees for 10 grams. So this also plays with the mind of consumer that, okay, prices have just shot up, let's wait, let it cool off, or so on. So I think there are multiple headwinds for this sector, or not headwinds, but I would say that next 12 months will be slow. And someone like a Titan who is keeping on experimenting with new formats, new local jewelry, deepening down its distribution, I think they may still be able to show some bit of positive growth, not something like 20% plus, which they showed last year, but more between 10% to 15% kind of growth. I think someone like a Kalyan would probably struggle a little more, because they do not have the the regional expertise, or the deep presence which Titan has, the multiple store formats which Titan has. So I think everybody will struggle. Titan will struggle less. Kalyan will struggle a little more, and maybe the Joy Alukas and the others will struggle even more. So yeah, in this sector we are more positive on Titan, but that too is a year of consolidation ahead for them.
Right, so Titan is the one to watch out for, but again, after a consolidation that one can see. We're just about the pre-open